So I posted a video a little while ago with just some basic numbers in 60 seconds saying that sales volume is down, but what is actually happening in the market right now and what can we expect moving forward in a little bit more detail? Before I get started, I just want to thank everybody for supporting the channel. It's grown pretty quickly over the last little while and I really enjoy doing these videos, so thanks for coming back and watching again. And if you don't mind hitting that like button if you enjoy this video and subscribe to the channel if you haven't already. Let's start off with sales volume going down. Yes, it's totally true. There's a bunch of sales that are not happening this spring that did happen last spring, and every seasonal trend that we have typically going back for many years other than 2017. Now, of course, we know that this is because interest rates are rising, but how exactly is it affecting the market? A lot of the time we use a stat called months of inventory to track exactly how hot a market is, and the closer you are to zero, the hotter the market is. Now, how we calculate months of inventory is very simple. You take the total amount of inventory in a given area and you divide it by the average amount of sales happening per month for the last couple of months. If that number is anywhere from 0 to 3, you're in a seller's market. Anywhere from 3 to 5 is balanced, and anything over 5 is a buyer's market. Now, at the beginning of this year, we were under 1 month of inventory, which meant that if we didn't get any new inventory, no new listings came to market, that the entire Toronto Real Estate Board would sell out of houses, including condos, in under a month. Since interest rates have started rising though, we've seen that number climb, but it's not really right across the board equally. That number's climbing heavily in certain sectors and not really moving much at all in other sectors. So let's start with who's getting hit the hardest. Out of the stats, we can see that York Region and Simcoe are getting hit the hardest, and they're getting hit the hardest in their freehold homes, and specifically detached homes. This is no surprise because those were the assets that were going up the most in value over the past couple of years. So a bit of a safer bet on pricing, just based off months of inventory, is condos. And the closer you stay to the downtown core, it seems to be the safer you are. A lot of buyers are feeling that commute when it comes to the price of gas right now, especially when they had purchased in the suburbs. The drive back to the city that I was talking about last year in the fall is starting to happen in a really big way, and interest rates are certainly helping. So we know that months of inventory can be affected by two different numbers. It can be affected by the total inventory or the amount of sales that are happening. So which number is it that's affecting that specific statistic right now, and why? Well, when we do a deep dive, it's not that we're seeing a flood of inventory. In fact, if you're a buyer out there right now, you've probably noticed that there isn't a huge amount of selection happening for you. And that's because there isn't. A lot of sellers have realized that interest rates are going up and are simply sitting on the sidelines. They don't want to sell for a lower price than their neighbors got down the street just a couple short months ago. So if we look at the total new listings hitting the market for this year in April, it's substantially lower than what we had last year in April. The seasonal trend that we would normally see in the spring of more listings hitting the market, but coupled with more sales volume, is not really happening. So if there's less of an influx of new listings hitting the market, how is it that months of inventory is creeping up so quickly? Well, it's because sales volume has basically fallen through the floor. Buyers have simply stopped buying. And if you watched the video I did last week with Jeff Mudrick, it's because borrowing has gotten a lot more expensive in a very short amount of time. And that's about to get a lot worse.
This morning, we raised our policy rate 50 basis points to 1%. And we indicated Canadians should expect further increases.
Let's start with June 1st. We're gonna see another interest rate announcement from the Bank of Canada, and everyone's talking about a half point in the news. Now, if interest rates go up another half point, we're still at historically low interest rates if we scale out, 20, 30, 40 years. But when we're looking at the relativity over the past 2 years, It's actually quite a bit in a very short amount of time. So I've been rambling on about numbers, but what does this basically mean? What is it boiling down to? Well, it basically boils down to this. Our market is on ice right now. Everything is just kind of stopping. Now, what does this mean for you? Well, it depends on who you are and what situation you're in. If you're a first-time buyer and you are sitting on a down payment, that money is burning a hole in your pocket with inflation and you need to store it in some asset. But right now, no asset is really that safe. All markets seem to be contracting right now, right across every sector. It doesn't matter if it's real estate, the stock market, gold, commodities, everything is contracting. What that means is you can't hold it in cash and you know you're gonna be buying something that might be worth a little bit less tomorrow unless you're shopping for a condo in the downtown core, but you know that you're gonna pay more for it in the monthly expenses that you were a couple of months ago. So your cash flow is gonna take a little bit of a hit, but overall, in the long run, you have to store your money in an asset because as inflation starts to taper off, those values are gonna increase, but your actual cash deposit will not return with it, and it'll still stay at a fraction of the value that it once was at. If you're a downsizer, this is not the time for you to be moving. You should not be downsizing in a downward trending market. And here's why. If you own a house that's worth $1 million and you'd like to downsize into a condo worth half that, and the market moves down, when the percentage basis boils out on your house versus the condo that you're gonna buy, for example, you will lose out more on the sale than you will gain on the prices going down on what you're purchasing. So if you're a downsizer right now, hold tight. This is probably not the right time for you. If you're an upsizer and you are looking to upgrade your home, this is a great market for you. Simply for the reverse reason that the downsizers shouldn't be moving. So whatever you're purchasing, in theory, should be at a dollar value cheaper on the discount of a downward trending market than what you're selling. And this can be really beneficial for upsizers. If you're an investor, it boils down to one very simple thing. How cheap can you get money right now? That's not necessarily a question that I can answer. Obviously, we know that borrowing has gotten significantly more expensive, but who do you know? Who are you speaking to? Are you speaking to the green bank, the blue bank, the red bank, or an independent broker? My advice is always speak to an independent broker because they usually shop things around and can find you a great deal. I hope that helps to break things down in a little bit more of a numerical sense so everyone's getting a good idea of what's happening in the market. And don't forget, if there is a property that you were looking at that has caught your eye and you want to know what it could be worth, feel free to click the link below in the description of this video where you can book in a quick 15-minute chat with me to go over the property's value, or just send me an email to adam@visionrealestate.ca with the property address and I will send you a custom video with my opinion of the value within 24 hours. Thanks for tuning in and I'll see you next time.